criteria, as I explained earlier in the elements, to this format in terms of definition of assets, 3 criteria: control, future economic benefit, and past transaction. For liability, again, in a similar way, we find that there are 3 criteria, that is present obligation, future economic outflows, and past transaction events. And when we go to equity, we define that how equity can be defined. That is the difference between asset and liabilities. If there is anything left, then we can call it as equity for the owners of the business. For income, we said that it has to be an increase in economic benefit that would result to decrease in liabilities or enhancement of the asset. So as a result would increase equity. But we cannot include all of these increase in economic benefit as income. Why? Because we do have some exception, and exception is that when there are some contribution by the owners, it expand the economic or increase economic benefit, but is not necessary an income for the business. And for the expenses, again, similar to definition of income, we have decreases in economic benefit, increases in liabilities, or decreases in asset. Therefore, that would result to decreases in owners' equity or decreasing in retained profit when we pay for the expenses. However, we have an exception for the expenses according to this definition, and that is when we pay dividends. Dividends is not an expense. Dividends is a payment out of owner's equity, so cannot be treated as an expense. And when we found the items, any of these items satisfy this their definition criteria, then we have to match the item with the recognition criteria. If the item can satisfy the recognition criteria, then we can record and report the items in our books. We have an attendance list. The attendance list doesn't impact your assessment. This is just simply an issue for myself to have a record of the attendance in each session. So don't worry about this requirement. All right, now let's continue. Do we have time? We might not have enough time, therefore we have to go a bit faster. Recognize or disclose. Let's put this in this context, how we recognize and report an item in our financial statement. First, we need to match the item with the definition criteria, whether it's an asset, liability, revenue, or expenses, and so on. If no, just put aside. This is not the case. We cannot take into account. If yes, if definition criteria are met, we take one step further, that is to match with the recognition criteria. Does the item satisfy the probability? That's the chance of occurring more than 50%. That is the probability. If yes, then the next, that is measurability. If it's measurable, yep, that means satisfy, therefore take this into account and record in your books. If not, that means the item with the assumption that satisfy all definition criteria but not recognition criteria. in such a situation, if the transaction is material or significant, then we might need to report as a important or material items in the notes attached to our financial statement. Let's go through some example. Is it an asset or an expense? That's a very simple case. You might have similar questions in the exam when we're talking about these issues. When we're talking about theory questions, these are basically the type of issues which you might face. That's one type of theory question which you might have in the question. Bearwood Enterprise, a media company, invested heavily in marketing to attract and retain customers, and staff training to improve customers' satisfaction. So payment for marketing and payment for the training. This is the main activity in this case. And the managing director has proposed to treat marketing and staff training costs as an asset rather than an expense. This is the way which they are approaching, or they want to approach, in the company's statement of financial position. Now, the question is that with reference to the conceptual framework, we need to evaluate whether these can be treated as an asset or not. If can, how? If not, how? Then this is the way which we need to attempt this question. That is, first, we need to check this with the definition criteria. Does this case satisfy all the asset definition criteria? Past events, yes, because the company paid for training and paid for marketing, yes. Then future economic benefit, perhaps yes, because it is expected that by increasing the marketing activities, the company increases the revenue. Therefore, it brings future economic benefit to the company. And also, when staff are training, it is expected that a better training for staff, it can attract more revenue in terms of dealing with customers and clients. So that is the first two. Control. Control is no. Why is no? Can you say why no without looking at this at the board to say why there is no, we cannot tick the control aspect or control criteria? Anybody?
I suppose it's because you can't control the possible benefit that the training bring onto the company, and also you cannot make sure that your employees after their training will stay in your company. You might just transfer it now.
Exactly. Good thinking. And this is exactly the answer which we expect if it comes as a question in the exam. In real life, you should be able to analyze in this way why companies do not have control on these two issues. The first one was on marketing. Yeah, we encourage customers, but customers, their own decision is not something in our control. So although we spend a lot on marketing, but customers can go anywhere, and including to our company. So we do not have any control over our customers. And the second case in terms of staff training. Of course, staff training improve the productivity in the company. Of course, it would and it could result to the increases in financial benefit or economic benefit. But do we have any control on staff? No. Because Deakin University perhaps may send me for various conferences, different training, but the next day when I come back from my training, I say, I want to go, and nobody can prevent me not to go. So that means Deakin University does not have any control on me, therefore cannot be, so training cannot satisfy the control issue. Yes, please. Sorry? But still, we do have control. We have the case later on. We will deal with that. When we do have a covenant, it still cannot satisfy the control issue. Sometimes we might have a contractual, say, agreement. But even that contractual agreement sometimes can be breached. Of course, has some financial consequence, but it can be breached, and we do not have such control. We do have an example. Shortly, we go through that one too. All right, marketing and staff training cost does fail the asset definition. So this is the point. If this comes, this question comes in the question, so this is what we want. You to be able to analyze according to what you understand from a conceptual framework and definition. So, the definition criteria fail. There is no need to discuss the recognition criteria of reliable measurement and probability occurrence. Remember that we follow the definition criteria with recognition criteria when the definition criteria all are met for a particular item. And then when all definition criteria are met, then we can follow these through the recognition criteria. But as soon as we find that at least one of the definition criteria, like this case, is not met, the case is over. That means we can stop because the control issue is not met, therefore we cannot follow this anymore. It's not the case indeed. All right, continue. The managing director should expense marketing and staff training costs. So how we can recognize these two items as an expense? We need to look at the definition of expense and criteria which we had for expense. Decrease in assets or increase in liabilities. Obviously, when we have training and marketing, company has to pay. That is cash expense which we make for this type of activities. A decrease in equity. Does it decrease in equity? Yes, because when we pay, indeed, the expenses reducing the owner's equity. That is decrease in asset or increase in liability in this form, and the result is reduction in retained profits. Is it a distribution to equity participant? Is it a distribution to the shareholders? The simple answer is very clear, is not. This is not a dividend. This is not a form of dividends or any form of payment to the shareholders. This is simply cannot be categorized as a distribution to the owners. So the definition criteria are met according to this analysis. Then we have to continue this with the recognition and recognition criteria. That is probability and measurability. Obviously, for probability, that is the chance of occurrence. That is 100% indeed for this case, because staff get the training session and the marketing is paid. So probably it's already happened. So this criteria is met. And reliable measurement, yes, because we know how much we pay for marketing. We know how much exactly we pay for training. So when we do have this measure, obviously that is clear and that satisfies the recognition criteria. Therefore, what is the conclusion? Training, staff, and marketing has to be recorded as an expense for the period which they occur. That is the case for these items. The second example, you need to think about, is it a liability or not, this case? A printing press operator, Bob, who suffered head injuries at work while carrying out his normal duties, is suing his employer, Perfect Printing, for damages as the company did not comply with occupational health and safety standards. The court has found in favor of the employee, as Bob's grounds for suing were very strong and highlighted the company's gross misconduct. However, the court is yet to reach a decision on damages. So everything is going smoothly in terms of recognizing this transaction, this event as a liability, except the later part of this case where it says the court is yet to reach a decision on damages. So let's go through the solution to see how the solution is. The question is, would the damage be included as a liability or not? This is what we are looking for the answer to this question. So, do you remember the criteria, liability criteria? Can you remind me about the liability criteria, please? Yeah, present obligation, past events, future cash outflows. Excellent, excellent. It's very good. It's very good. All right. Now we start with this one. Present obligation. Is it a present obligation?
Yes.
Yes, because it seems all information available indicate that company has to pay some compensation to this guy. So that is a present obligation based on information which we have. Result in an outflow of future economic benefit, it seems it has to be yes, although the court hasn't made any decision yet. But the flow of the information, the flow of this event indicate that the company has to pay, and the payment obviously would be in cash or sort of benefit like cash. So past events, yes, because this has happened in the workplace, and that was as a result of activity which was directly related to this particular entity. So definition criteria all met. So we have to go through the second step, that is the recognition criteria. For recognition criteria, we have to assess this item for two criteria. One, probability, and the second is measurability. Right? About the probability, what you would say? Yes or no?
Yes.
Yes, because it seems that the court is in a direction to rule against the company for the payment. So probability is met. What about the measurability?
Yes, it can be any amount in financial.
Right. So when your answer is yes, then that means you have to record this as a liability and report in your financial statement. If you say yes, then how much you will record as a liability?
Depending upon, we can see the last year case, how much the compensation.
If there is no any last case, how much you pay? How much you will?
$1,500.
How much?
$1,500.
Why you say $1,500? How did you get this figure?
Because he was admitted into hospital, the expenses for that also would be paid.
But the hospital might be much more than this. We don't know. Yeah, the simple answer is that we don't know, because the case is clearly says where is the case. The says is that the court is yet to reach a decision on damages. So that might be 10,000, that might be 100,000, that might be $1 million. So when we don't know, that is a big question mark on measurability. So when the case has an issue with the measurability, then we cannot record this item as a liability. It might be a significant issue. It might be a significant event for the company. And if this was the case, simply, although we cannot report in the face of our financial statement as a liability, but in the notes attached to the financial statement, we need to disclose to our users of financial statement that we do have this case, but we are not able to measure because of the reason which we mentioned that is not determined by court, or our lawyer cannot determine any particular figure and so on. So that is the conclusion for the case, that it is a possible liability, is a contingent liability, which we talk about this later on, about the contingent liability. That is a contingent liability, and the contingent liability, if it is material, if it is significant, it has to be reported in the notes to the financial statement. All right, that is your case. Now let's spend a few minutes on this case, and then we go through the solution. Joe, the managing director of Think Limited, has signed a restrictive covenant following his resignation on 15th of May 2016. The restrictive covenant is to prevent Joe from working in competition with Think Limited for a period of 3 years. Think Limited paid Joe $250,000 in respect of the agreement. Joe is required to compensate Think Limited $500,000 shall he breach the terms. Think Limited has recognized the restrictive covenant as an asset in its statement of financial position as at 30th June 2016. So this is the case. What is the question? Evaluate whether Think Limited recognition of the asset in the statement of financial position as at 30th June 2016 has met the requirements as per the conceptual framework for the preparation and presentation of financial statement. All right, work on this for say 1 minute, and then we go through the solution. You can discuss with each other to see. Just go through the definition criteria. Remember about the definition criteria for the role, past event, future economic benefits, and then the recognition criteria about probability and measurability. Now, you need to look at this case to see whether you can recognize this as an asset or not. All right, guys, let's go through the solution. Okay, we are talking about evaluation of the case, whether it is an asset. So directly we have to go through the definition criteria for asset, and then this followed, if satisfy all definition criteria, go to the recognition criteria. So we start with the definition criteria, past event. Is it a case of past event?
No, it is a case of future event.
Why is a future event?
Because if he breaches the contract, then only he will be paying $500,000 to the organization.
Right, but the case is here about the contract, about the covenant, the value of the covenant, whether this company can recognize this as the contract, the value of the contract as an asset or not. This is the past, because it's already contract signed in the past. Therefore, the answer would be a yes answer, because this is something that it was made an agreement between the company and the director. Future economic benefits. Is there any future economic benefits? Yes, because if the director breach the contract, then he has to pay $500,000 for the breaching of this covenant or the agreement which they made. So restrictive covenant prevents Joe from working in competition. But if they decide to work in any way, they have to pay, or he has to pay $500,000. Therefore, the value is there. Future economic value is there. Control. Do they have control? No. They don't have control on this contract. Because although there is a contractual agreement between these two parties, but still the contract can be breached and paid by 500, or not breach and not pay the contract. So there is no control from the movement of Joe, whether he decides to go to join with the competitor and then perhaps pay the $500,000 or not join. This is something that this company, the Finn company, has no control over this case. Therefore, again, as we discussed earlier, because definition criteria are not met, therefore we don't need to go any further. We have to stop it, and the conclusion is that this is not an asset, or the contract is not an asset. All right, now let's move on to the next part, that is accounting equation. Accounting equation. What is accounting equation? Accounting equation is a foundation of the balance sheet. Is the basis of what we report in our balance sheet. And the equation can be defined in this way. Owner's equity is equal to assets minus liability. This is what, when we discuss about the accounting elements, we define how equity can be defined. Now let's make a little bit modification in this equation to see how we can present or represent this equation. Asset is equal to liabilities plus owner's equity. That means the source of resources, our asset, is either financed by creditors, that is liability, or by the owners. So you buy a car for, say, $20,000. You pay $10,000 in cash and $10,000 on credit. You borrow on loan. So how would be your accounting equation? You have a car that is asset, $20,000, The other side of your accounting equation is that liability, the loan, $10,000. The balance is owner's equity, what belongs to you. Look at the previous formula or equation. Owner's equity, assets minus liability. So asset was $20,000, liabilities $10,000 in this example which I made. That is your equity, that is $10,000. You can put in the same way in the modified equation. $20,000 your assets, $10,000 your liability or loans, and $10,000 which you put in these for the purchase of this car. Owner's equity in the context of companies can be break down to two parts: capital and retained profit. What is capital? That is a contribution by the owners. What is retained profit? That the profit which is not used and distributed to the shareholder. That is referred to as retained profit. How retained profit at the end of the period can be analyzed? That is in this way. Retained profit at the end is calculated in this way as retained profit at the beginning of the period plus net profit or minus net loss if it was a loss, and minus dividends if there was any dividends payment. And then the result would be retained profit at the end of the period. And when we're talking about profit, profit is generated when revenue or income is greater than expense. The other way around, when revenue is smaller than expense, then the result or the performance would be a loss for the entity. And dividends, as I mentioned earlier, dividends is not an expense for the businesses, is indeed a distribution of the owner's equity to the shareholders, to the owners. So the expanded accounting equation is assets is equal to liability plus capital plus retained profit at the beginning of the period plus revenue minus expenses minus dividends. It seems a bit complicated, but it is not. Just think about this. It's very rational. It's very simple in terms of the concept to learn this by heart. It's very. Just come back to my earlier example. 2 times 3. You don't need to think about this. That is 6. This is something that you need to practice to come up like 2 times 3 to you. All right, now let's go through this example quickly, and you can help me for this example to see how we go. You need to practice. Please put on your paper rather than just thinking about you know about this. Just put on the paper to see whether you know or not. This is the way which you can learn more effective in accounting. 30th June 2016, Lisa Limited reported $4,000 equity and $6,000 asset. What was the liability reported by Lisa Limited at 30th June 2016? 2,000, excellent. Yep, that is a good progress for our class. That is, asset is liability plus equity. So simply we can move the liability to the other side to find out about the sorry? $500. Of the next one. You're talking about the next one. All right, good. Okay, during the year ended 30th June 2016, Mona Limited earned revenues of $2,400 and incurred expenses of $1,600. Retained profit at 1st of July 2015 were $1,400, and at 30th June 2016, $1,700. What was dividends declared by Mona Limited during the year? That is obviously goes through a bit of calculation, and the dividends that you should have is $500 based on the calculation which we showed earlier, the formula which we showed earlier. You should come with this amount of dividends as retained profit beginning plus net profit minus dividends is retained profit at the end. So to work on this, you will come up with a dividends of $500 for this case. Okay, now let's go through this task. During the year ended 30th June 2016, Shai Limited reported 1,200,000 asset, 4,000 capital, 4,000 revenue, $2,000 expense, and declared 3,000 dividends. The retained profit at 1st of July 2015 was $3,000. What was the liability reported by Shai Limited at 30th June 2016? How much is that? No. $6,000, yes. And how is calculated? Just putting in this context for accounting equation and put your figures in, and then you will find that the liability has to be $6,000 according to the All right, now let's move on to the next step where we talk about cash versus accrual accounting. Can we move on? All right. We need to think about cash and accrual accounting. What is the cash accounting? Cash accounting has a very simple concept. That is, we account for the transaction, we account for the revenue and expenses when we receive cash and when we pay cash. So very simple in terms of when we can determine revenue and when we can determine the expenses. It is very objective because it's based on cash exchanging, but it is not an accurate measure of profit. Why is not an accurate measure of profit? These are listed as some of the problem which we might find if we do under the accounting, cash accounting. Selling merchandise stock on credit. So you sell now, that's a part of the operation. The sales is incurred, but you do not take into account until next year when you receive from your creditor. So that is a big problem for cash accounting because the selling is incurred this year, the transaction has happened this year, but you are not or you cannot take into account a proper measure of profit for this year because you should wait until next year when you receive the cash. So this is one of the typical type of problem if you go with the cash accounting. Machinery utilizing, diminishing its useful life. We buy a van for our business this year for $20,000 and we expect to use this van for 10 years. Under the cash accounting, as soon as we pay for this van, which is this year, we account for $20,000. And then we use this across 10 years. So this is not an accurate measure of the expense because the van is going to be used in 10 years. It's going to give benefit in 10 years rather than just accounting for this year. So we need to account for depreciation, which we will talk about later on. Therefore, this will give an inaccurate measure of the expenses because the expenses is not this year expenses. The cost is not an expense. The cost indeed is an asset, and it has to be depreciated over its useful life of the asset, which we will talk about later on. using services today that will be paid for in a later accounting period. The electricity which we use until 30th of June, say 2018, the bill is paid, say, sometimes in August 2018. So when we are accounting under the cash accounting, we cannot account for these expenses until August when we pay. But the accrual accounting says, no, the expenses incurred by 30th June, therefore we need to account for expense on 30th June. Although it is not paid, but we have to account. That is the accrual base. And waiting until 30th of August, that is a cash base. Receiving money in advance for services to be provided in the future. There are many examples: magazine subscription, airline tickets, book, or say you are all very young, you use gym and you pay the membership fee in advance. So you pay in advance for 12 months to use in the next 12 months. Obviously, payment for the next 12 months is not a revenue for the business or the gym owners or the gym company until the time passes and this the in advance payment converted from liability for the business to say revenue. So under the cash accounting approach, as soon as they receive, they should record as a revenue. Whereas under the accrual base, this is not a revenue. This is a liability. So it gives a lot difference between these two methods in terms of approach. To cope with this problem, most businesses use accrual accounting. So it is subjective, the cash accounting, it is subjective, but it is not accurate. We want an accurate measure of our performance. An accurate measure of the performance cannot be achieved without using accrual method, because accrual methods measure the impact of the transaction at the time which they happen rather than at the time which the cash change hands. So this is why accrual accounting is adopted by all accounting standards and all business and major